All right, in today's video, I'm going to try and convince viewers not to make the same mistake in the stock market that I very often see people make in the metals market, in that they once the rally becomes mature and people's emotions become convinced that there's little or no risk, that the Fed's got your back and the market can only go up, and then they end up the fear of missing out causes them to buy late in an intermediate cycle, and then they get caught in an intermediate decline. I've seen this happen over and over in the metals market, where traders that trade metals tend to be a little bit more emotional, I think. But it also happens here in the stock market. And so there's going to be a temptation to want to keep chasing, or if you miss the rally, you want to you're going to be tempted to want to buy the stock market here, thinking that there's little to no risk in the stock market. And I'm going to advise that it's time for a dose of delayed gratification. There may still be some upside in the stock market, but I don't think it's worth trying to catch. I don't think there's that much. There's definitely not 10% potential, probably not even 5% potential, and I question whether there's even 2% potential in the stock market. So you don't have a lot of upside reward, and price has gotten, as I've shown in several videos, price has gotten stretched quite far above the 200-day moving average. That is a risky market. Regression is going to want to pull that back down at some point. So you're risking, by chasing in the stock market, you're risking getting caught in the regression event when it starts. And the later it gets in the intermediate cycle, and we're going to be on week 17 next week, the more likely it is to get a crash event. There's got to be a period of time for the declining phase of the intermediate cycle. And when the rally runs very deep into the intermediate cycle, then there's just not a lot of weeks left for that intermediate decline to unfold. So it can very often occur as some kind of a crash or mini crash event. So next week is week 17. That's very late. This intermediate cycle topped on week 16, and then you can see what happened. Multiple weeks moving down into an ABC correction into this intermediate cycle low. So at this point, there is risk of getting caught in that top. What we want to do as traders is not chase 17 weeks into an intermediate cycle. We want to try and get in on week 1 of a new intermediate cycle. So, one of two things. You could either just hang out on the sidelines for the next, I'm going to say 4 to 6 weeks. Somewhere in that time frame, we're probably going to get a move down into an intermediate cycle, though my guess is it's going to be in September. That seems to be usually when you get those big scary crashes. So at some point here, we'll get an intermediate top. Maybe we already formed it here. And then we'll start to move down into the intermediate cycle low. So September's probably going to be your really good buying opportunity in the stock market. Not now. You may, if you buy now and it goes up, you're going to think you're brilliant, but then almost certainly what happens is you just get caught when the market tops. They don't ring a bell for you at the top, and so the next correction looks just like this correction or this correction or this correction, and so you assume that the dip buyers are going to come in and that your position is safe and you don't have anything to worry about. But then one of those dips turns into one of these, turns into an intermediate degree decline that lasts, instead of a few days, it lasts several weeks. Or a month or more, and is a much bigger correction, anywhere from 5 to 10 or even 20%. So risky right now. I don't think you have much upside potential, but you got a lot of downside risk, and it's just late in the intermediate cycle. So as I've been cautioning precious metal investors, you don't want to buy late in these intermediate cycles. There may still be some upside potential, but it's not much. And the risk is that you won't get out in time before the top occurs, and then you get dragged down into the intermediate cycle low. So that's what's happening here in the stock market. So there's been some questions, subscribers, whether or not this was a daily cycle low, and I don't think it was. I think it was starting to be a daily cycle low, and I think the Fed, the plunge protection team, the current administration just pumped a lot of liquidity into the markets, kind of aborted this move into the daily cycle low a bit prematurely ahead of the holiday season. I've explained this before. During these holidays, they want people optimistic. They want them spending money, and so they just temporarily aborted the move down into the daily cycle low that was getting started. Same thing happened right here ahead of the FOMC meeting. I've noted this before as well. They will usually try and pump the market up ahead of an FOMC meeting. It's just easier to make for the Fed to make decisions if the market's going up, and then the daily cycle low resumed once the FOMC meeting was over. And so I think that's what happened here. They just pumped a lot of liquidity. We got a kind of an artificial bounce, but now it's time for this to finish that daily cycle low. And so this move, of course, it did not break this trend line. That's one of the parameters that usually has to be met in order to confirm a daily cycle low. The 10-day moving average did not turn down. Again, another parameter that I usually require to be met to signal a daily cycle low. It did not retrace at least 38%. In my opinion, this was starting a daily cycle low, but it was just aborted a bit prematurely, and now it needs to finish. And so if this is not a daily cycle low and it's still ahead of us, then we're really late in this daily cycle. And what did I say is that these rallies that last really late in a cycle can produce some kind of a mini crash event, because they've run out of time to complete the cycle correction, so it has to do it in a very short period of time, which can very often result in some kind of a mini crash. So the risk right now is that the daily cycle low is going to resume, and because it's run out of time and has to compress that correction into a short period of time, could be quite severe and sudden, and it needs to break this cycle trend line. So that is your risk chasing the stock market, is that the move into the daily cycle low resumes, and it resumes with some really big scary down days, like 70 to 100 point down days in the S&P to break this trend line and complete that daily cycle low. And then I think we get another bounce, and that probably rolls over, left translates without making a higher high, and then gives us that intermediate cycle low in September. And that's where you want to buy the stock market. You want to buy at the beginning of these intermediate rallies, not 16, 17 weeks into the rally. Now, there is a market that is potentially about to begin an intermediate rally, and that is gold, and that's what I have been pushing. And there's going to be the temptation for investors to just keep chasing this because they keep getting rewarded here, and in the meantime, gold hasn't really done much. But if you can take a longer term view, you can rationalize that once the intermediate cycle low in gold is done, then you're going to get something in gold that looks like this, and you're going to be getting in at the bottom and riding the entire rally instead of waiting 16, 17 weeks before you buy. So it is worth some delayed gratification and continuing to focus on the metals market, because the opportunity is and the potential is that you're getting in on week 1 or week 2 of an intermediate cycle. So you're getting in here preparing to ride a big rally, whereas in the stock market you've already missed it. If you didn't ride this rally all the way up to here, it's too late now. It's too much risk. So again, as long as I think that we haven't put in the bottom in metals or put in the bottom and rallied too much, once we've rallied for 2 or 3 weeks, coming out of that ICL bottom, then I'm going to turn off the subscriptions for the SMT, and the people that got on board, and hopefully they will listen to me and buy here at the bottom, and we'll just hang on to those positions and ride this intermediate cycle. Then they will get rewarded for their patience and getting in at the beginning of an intermediate cycle rather than giving into emotions and buying at the end of an intermediate cycle and potentially getting dragged down into an intermediate degree correction.